Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend. Today we are going to be doing technical analysis for the S&P 500 for Friday, March 13th, 2020. And for this analysis, we will be using stockcharts.com. That is the service that I pay for, and I will leave a link to their site in the description box below this video. So we had a bit of a rally here for Friday the 13th. We were up 9.28% on the S&P 500, and we finished at 2710.95, so 2,710.95 on the S&P 500, and we technically are no longer in a bear market. We're only down 19.94% from our closing high on February 19th, which is where we closed at 3386.15. So what had happened at the last few minutes of the day here, and by the way, this is a 5-day chart where each candlestick represents 5 minutes of trading in the S&P 500. And what you can see here is at about 3:15 this afternoon, 3:10, 3:15, the president came out and started to talk with his group, and they are putting at least $50 billion towards a stimulus plan to combat the coronavirus disease and the spread of the disease. So that really gave the market a boost right there at the last 20-25 minutes of trading, and it took us above the 2,700 mark and technically put us back out of a bear market situation. But guys, I really feel like this is a short-term high. Will it help, and is it great? Yeah, it's fantastic. But please don't mistakenly think that all is well now. I just don't see that is the case. Okay, so you can see up until that stimulus package was announced and the emergency measures were announced by the president, you can see that over the last couple of days, here's Thursday, here's Friday, you can see that we were predominantly trading in a sideways pattern between about 2660 on the high end and then 2480 on the low end. So it was right here when the stimulus measures were announced that we started to get that huge spike and broke above that 2700 area. Again, 2708.94 is technically the exact number, where anything below that, we're in a bear market. Anything above that, it's still considered a correction. So anything less than 20% down from your all-time high is considered a correction. Anything that's more than 20% down from the all-time high is a bear market. So technically, we just pulled back to where we're 0.06 above what's considered a bear market. So, but I'm just giving you the exact numbers here, guys, for educational purposes. But the reality is this is still an extremely serious situation. And when we move on to a longer chart, and now what we're looking at here is a 7-year chart of the S&P 500, where every candlestick represents 1 week of trading on the S&P 500. And you can see that for the week, this is the week now over here on the right, so you can see for the week we had dipped down to that 2480 level that you saw in the previous chart. And now, again, we finished up above that 2700 level. And again, 2700 is just a lot easier to remember than 2708.94, which is, again, the exact number that you need to get into a bear market in the S&P 500 for right now. And that's why I have that line there at the 2700 level. But, again, there's been a lot of stimulus from countries around the world that have come out in the last 24 to 48 hours, which definitely gives the market a short-term feel-good, and it should help to some degree. However, when you think about all of the events that are being canceled around the world and the lost revenue to the companies, there's no way that these stimulus measures are going to make up for that. All right. So when we look at revenue of a company, and then just in the aggregate, in this case, the S&P 500, there is no way that these companies are not going to have a decline in revenue and profits for calendar year 2020, knowing what we now know. Okay. And as mature people, as business people, as traders and investors, we have to always be ready, willing, and able to make new decisions based on new information. Now, back here, right, first couple months of the year, it looked like, profits and earnings were going to be up for the year, and we were going to finish, at records for the S&P 500. Analysts were estimating north of $178 worth of earnings on the S&P 500. Last year, we finished up, for 2019, finished up about $162 and change for earnings on the S&P. I think a reasonable guess is that companies are probably going to come in about 33% under that. So in other words, I think, this year, calendar year 2020, knowing what we now know between the coronavirus, the oil markets, and what's going on in the bond markets, I think it's safe to say that companies are going to earn less in 2020 than what they did in 2019. Hopefully most of you agree. Now, with that said, let's just put a ballpark number on this and say, okay, they're going to earn a third less. All right, so that's 33%. Well, what that means then, right, when you get contracting earnings and then you get contracting multiples, as we have here, where people are not as willing to pay up for earnings because they're afraid, that means the stock market continues to fall, okay? So I still anticipate us going to at least 2350, which is where we started this whole rally from the end of 2018. But guys, there's just not that much support there. And when I've been playing around with some models, if you will, just looking at earnings times reasonable multiples, and couple that with the technical analysis. So I consider myself a techno-fundamentalist, where I'm looking at both the technicals and the fundamentals and trying to come up with reasonable assumptions as to what is probably going to happen for any given situation, whether I'm looking at one stock or the entire stock market itself, like with the S&P 500, which pretty much covers all of the market for the United States. Guys, there's just no way that this thing is over. Yes, these stimulus packages feel good in the short term, and they'll help to some degree, but they're not going to fix what is ailing the stock market, okay? So just don't be thrown off base by, this last minute rally, this last few minutes of rallying in the S&P 500 for Friday the 13th. Yes, it's a short-term feel-good. Yes, it's a good thing, but we're not over with this yet, okay? So, just be prepared for it to get worse, because I don't see any way that things don't get worse for the next few months. And then, at some point in the future, right, things will get better. But anyway, with that said, so 2350 to the downside, I think, is our bare bones minimum that we're going to see before this is over. But guys, I really don't feel that that's the bottom. I think at the realistic downside to this is at least into this zone somewhere between 1900 and 2100. So let's call it 2000 as the midpoint on the S&P 500. And round numbers. Any of you that have been following my work for any length of time now know that round numbers have for over a century been known by traders and investors to provide at least psychological support, and we've seen it. We saw it back up in here at 3,000. We saw some trading right around in there, both going up and down, where at least for a short period of time it was holding up. But you'll notice that round numbers do provide some level of support. Okay, so in this case, this 2,000 level plus or minus 100 points, you can see back in starting in 2014 all through 2015 and then the beginning of 2016, this area between about 1,900, maybe a little bit lower than that, but let's just call it 1,900 on the bottom and 2,100 on the top. That area provided a lot of support and resistance, and provided a lot of trading. Okay, there was a lot of trading for about almost a year and a half in that area. That, to me, from a technical standpoint, as well as just fundamentally and looking at what is going on in the markets and thinking about all the lost revenue that is going to happen around the world because of the measures being taken to combat the coronavirus, the spread of the virus, but also because of what's going on in the oil markets. And guys, now we've got problems in the bond market. So we have a perfect storm here, okay? And yes, it's nice when governments come out and throw billions of dollars at the problem, but that's like putting a Band-Aid on a broken leg, all right? If you have a skinned up knee and you broke your leg, okay, you put a Band-Aid on your skinned up knee, you might feel better a little bit better, but the reality is you still have a broken leg. Okay, so I think that's what we have here is a situation where these little measures are putting band-aids on the situation. Might make us feel a little bit better in the short term, but the underlying problem is still there. All right, I mentioned these levels here, this 2,000 plus or minus 100 points. Okay, it gives us kind of a little bit of a range. Again, a lot of trading for at least a year and a half between midpoint 2014, middle of the year in 2014 through Q1 of 16. And let's also take a look at this from a Fibonacci standpoint. So what we're looking at now is the entire bull market from March 9th of 09 through February 16th of this year. Okay, so that was the entire bull market before we hit this bear, which technically we were only in it really for a day so far, a day and a half. But I don't, there's no way this is over. Okay, so when we look at this though, Fibonacci numbers, the key numbers are 38.2% and 61.8%, and what they are is retracement numbers from your whole prior move. Okay, so again, the prior move, March 9th of 09 through February 16th of this year. You draw these lines. The charting service drops, I don't pick and choose these things, right? I just start at the beginning, go to the end, and the charting service drops these lines in there for me. So what we have here is this 38.2% retracement of the entire bull market that we had for over 10 years aligns perfectly with this 2350 area that I was just showing you over here, okay? So the exact number is 2351.91, all right, but 2350, okay? So that's this point here, and that's why I say this 2350 level is pretty important. It aligns perfectly with a 38.2% retracement of the entire bull market that we had, but it also is, again, where we stopped at the end of 2018, which is why I have that line there. A little bit of, activity for a few months around that area in 2017, but there's just not a ton of support there. Now, a 50% retracement is not a true Fibonacci number. However, for technical work, a 50% retracement of a prior move is very common. So the software, in this case, StockCharts.com software, automatically draws that line for us. And a 50% retracement of the entire bull market would take us down to 2030.16 based on where I have these lines set, okay? So that 2030 area, again, comes right back to here, right? I just drew this line at 2,000. It's close enough, guys. So, anywhere between 1,900 and 2,100, with 2,000 being the midpoint, should provide quite a bit of support once we break below 2350, which I think is just a matter of time, guys. There's just no way that I just don't see any way that this doesn't happen, okay? So we need to prepare ourselves to go down to at least this 2,000 area. We should be prepared for this. And guys, it could get worse than that, all right? Let's not fool ourselves. But, right now, great thing is we're above 2,700. That's fantastic. But the reality is we're going to, in my opinion, and based on my technical work, based on thinking about the fundamentals, what the earnings are going to look like, at least the possibility of what the earnings are going to look like for 2020. I see no way around it. And then once we break 2350 to the downside, as you can see, there's just not a lot of support until we get down to at least this 2100 area. And then kind of the midpoint of that is that 2000 mark. Again, 2000 being a round number should psychologically provide some support. There's probably some algorithms, would be my guess, that are written around that 2000 number. It also aligns with that 50% retracement of the entire bull market from March 9th of 09 through February of this year. So for a lot of reasons, I think this 2000 area plus or minus 100 points becomes extremely important, but that's still a ways off from where we have closed today. And as a matter of fact, I just ran the math on this, and if we fall from, and I just refreshed the screen and it went up a couple, just a little bit, but 2711.02 now is what the S&P is saying it closed at for the week. I started recording right after 4 p.m. Eastern Standard Time when the market closed, so some of the data was still coming in, so we went up just a hair from that 2710 area to 2711. But anyway, at 2711, when we take 2100, okay, so from 2711 to 2100, that's 611 points. We take 611, divide that by 2711, and that's another 22.5% to the downside. So guys, just understand it's not too late to protect yourself here, okay? If you've already lost, 20%, I'm sorry about that, but that's, again, where my work comes in. My simple market signals proprietary model helps protect people. It helps you understand when to, when it's safest to increase the risk exposure to the stock market and when it's most dangerous. I have two components to my simple market signals system. There's a risk-based component and a trend component, and I'll tell you a little bit more about that here in just a few minutes. But as we can see here, even if we just go down to the top of this range at 2100, okay, from where we closed this week at 2711, that's still another 22.5% to the downside. And guys, I'm sorry to tell you this, but it could get a lot worse from there, okay? So don't underestimate how dangerous this entire situation is between the coronavirus and the massive, it's just like slamming on the brakes on the entire global macro economy, guys. This is potentially very, very serious and very damaging to portfolios, to companies' earnings. There's going to be companies that are going to go out of business. There's going to be tens and tens of millions of people that are going to lose their jobs over this. So we're just at the very beginning of this. All right. So please don't take this lightly. And protect yourself. And you need a system that helps you manage risk. Okay. I would encourage you to take a look at Simple Market Signals. It's less than $20 a month. I have priced this thing as affordably as I can so that the masses can afford it. Okay. So that anybody that really wants it can afford it. Most anybody can afford $19.95 a month, guys. That's less than 67 cents a day, okay? And that's all this costs, but it's going to help you in so many ways. Now, we're obviously out on my YouTube channel, the Rodney E. Constable Success Channel, and I want to show you a couple of videos that you're going to want to watch. And by the way, I will leave the link to these videos in the description box below this video. But if we go back to 2003, okay, a real tough time in the market, I went back and I looked at simple market signals in that time frame. So you'll see how simple market signals would have worked in that time frame. Same thing, 2007 through 2009. Each one of these videos, by the way, is less than 5 minutes long. So you'll just need to invest about 15 minutes of your time to look at the charts and see how simple market signals worked in these time frames. And then another real tough year in the markets was 2018, where the markets were down. But using simple market signals, you could have easily had a nice little profit in 2018. The rest of the market was negative. You'd have made money in 2018 using simple market signals, okay? So I would encourage you to go out and watch at least those 3 videos. And if you want even more information, introducing simple market signals, which is about a half-hour video, that gets into more detail. And then if you want the whole story, the Successful Investor webinar, which is about an hour long. And guys, there is so much great information in there. And I get into the bond markets and why high-quality bonds are not going to be in a position to help offset equity risk going forward. I've been telling people this for years, but we're seeing it happen. Just yesterday, the Fed had to step up and throw money at, some stimulus directed at the Treasury market because the Treasury market was seizing up. All right. So these are not normal times, guys, and we cannot use the same tactics that maybe worked, 20, 30, 40 years ago or even 10 years ago to address these markets. It's not going to work. And let me show you what I mean when I say that you're not going to be able to use high-quality bonds or even gold for that matter to offset equity risk as you could in the past. So what I've done here is I've loaded up the S&P 500 gold, which is the ETF for that is GLD, and then we have the 7 to 10 year Treasury ETF IEF, and then we have the 20-year plus Treasury ETF TLT. And for this week, the S&P 500 was down 8.79%, gold was down 9.06%, and the 20-plus year Treasury bond ETF was down 7.69%, guys. So in the past, to address systematic risk, you used to be able to count on high-quality bonds being the diversifier, if you will, right, as far as an asset allocation portfolio to offset your equity risk if you had a 60-40 or 70-30 portfolio or whatever, all right? And then a lot of people will reach towards gold. Guys, with the bond yields being so low these days, the bond market is distorted because of central bankers' actions from around the world over this last decade, from going clear back to the last financial crisis that started in 2007. All right. So the bond market is not going to be in a position to help you going forward. You have to have some kind of a loss cutting strategy. You have to have a risk management strategy in place. And whether you're going to choose to use my system, which is already in place, took me over 20 years to figure this out. It flat works. I have financial advisors that are using it. It's less than $20 a month. And guys, it works. Okay. Again, I've got a risk-based component and a trend component. So you'll understand where, if risk is low, stocks can grow. If risk is high, stocks are going to die. And then you'll understand the risk component based on the signals. And then you'll also understand the trend component. So you'll have, which direction is the market trending, up or down. And so whether you're a novice investor or a seasoned pro, this system, Simple Market Signals, will help you, okay? And it's super cost effective at less than $20 a month. But guys, I hope you're starting to see here that I'm not just blowing smoke. This is serious. I want to help people, and it drives me bananas that people are not seeing this, all right? Again, the 20-year Treasury was down almost as much as this S&P 500 for the week. Now, we had that little pop at the tail end of the day, right, which kind of distorted these numbers a little bit. But I hope you can see here that, gold didn't help you. The 10-year Treasury didn't help you. The 20-year Treasury didn't help you. There's just, so a traditional portfolio of stocks and bonds isn't working like it used to, okay? And it's not going to going forward, guys. And some of you have heard me say this, but I want to repeat it for this video as well. The bond market to me is absolutely the scariest thing out there. The pain that we could experience over the next 5, 10, 20 years because of the bond market is far beyond anything the stock market could do, to us. So I'm not trying to be, dramatic here. It's just a fact. And let me make one other little point here, just to kind of drive this point home. Okay, so what we're looking at now is the yield, a chart of the yield on the U.S. 10-year Treasury bond, okay? And so what we can see here is we closed at 95 basis points. The way you need to read this is you need to move that decimal point over and just understand that 100 would be 100 basis points. That's 1%. So we're yielding less than 1% on the 10-year Treasury. Now, let's just use 1% for easy math here, guys, and stay with me because this is super important for you to understand, all right? What that means is for every $100 you invest in a 10-year Treasury, you're going to get $1 of return at the end of the year at a 1% yield. And by the way, that's taxable, okay? So whatever your tax rate is, let's say 30%. For most of us, it's going to be roughly 30% or whatever. So that means after tax, you're going to yield 70 cents in your pocket for every $100 you invest. That's what that 1% means. Now let's flip that upside down. What that also means is you're paying $100 for every dollar of earnings, all right? Your PE, your price to earnings ratio, is 100 on a 10-year Treasury. The stock market right now is trading at about 16 with this pullback, 16 times last year's earnings. Now, I do think that earnings fall. My guess, I'm just going to take an educated guess and say, okay, earnings are going to be 33%, below where they were last year, right, for 2020, based on what we know right now, which is very little, but we know that there's no way companies are going to earn what they earned last year. There's just no way, right? So we have to count on falling earnings, okay, and probably PE contraction, which is, again, what happens in a bear market or a downturn, right? You get companies are earning less and less money, and investors are afraid, and there's uncertainty, so they're not, keep in mind the stock market's an auction. So with every day, right, the stock market ding opens up, and it's an auction. It's an auction to buy and sell stocks. And so in this auction marketplace where there's less and less certainty as to what companies are actually going to earn, investors are not as willing to pay a PE of 18, 19, and 20 like we've seen in the last few years. They're going to come in and they're going to want to pay, 16, 15, 14 times earnings for what they hope the earnings will be at the end of the year for these companies, and then in the aggregate, the S&P 500. I know I'm going off on a tangent here, but I'm just trying to paint the picture that that is exactly what's going on here, okay? And by the way, I have a video out here, why stocks go down, okay? And you know, if you're newer to investing or just want a refresher, as you can see, it's a 10-minute video, why stocks go down. It walks you through exactly what happens when we get into these scenarios where you have earnings falling and PEs falling, all right? So these two really good videos, why stocks go up and why stocks go down, especially for those of you that are newer to investing, these are really, really good videos. And also why losses matter, all right? It's super important. It's less than 3 minutes long. It's super important for you to watch that video, even if you're a seasoned professional, because you really need to understand what it means when you're down 15, 20, 30, 33%, and what it takes to earn that money back, okay? So again, on a 10-year Treasury, you're paying $100 for the potential of $1 of earning right now. So that's not a good value, okay? And we just saw the fact that, you know, it didn't matter what you were in this week. Bonds went down, gold went down, stocks went down. So, you know, this is systematic risk, guys, and systematic risk is undiversifiable. Now, in the past, you could use high-quality bonds, treasuries, to offset systematic risk. But the bond market is so distorted, it's so dangerous these days that it's not going to work going forward, okay? So I want to encourage you to take a serious look at simple market signals and how that's going to help you, because it will help you manage your systematic risk. Guys, going forward, it's going to be about being in cash or being in equities. And remember, cash is an asset class, okay? A lot of people don't realize that. A lot of people just forget that or whatever. You know, they say, well, I'm not earning anything. Well, yeah, but you're not losing money either, okay? So I think to be a successful investor and trader going forward, you don't have any choice. You didn't do this to yourself. The marketplace is now this way because of the distortions of the central bankers from around the world and all the stimulus over the last 10 and 20 years. The bond market is distorted and things are just not working like they used to. You know, stocks are definitely, in my opinion, the better value for the long run than bonds. However, to minimize your losses, maximize your profits, you then need a system that helps you understand when to step on the gas and when to step on the brakes with respect to your exposure to equities. And that is exactly what simple market signals does, okay? If you don't want to use simple market signals, you better come up with something else, guys, because I'm telling you, this is what it's going to take going forward. You're not going to be able to have a traditional asset allocation portfolio that's going to work very well at all going forward. So to make money in the stock market, to be successful, you're going to have a loss-cutting strategy, a risk mitigation strategy, right? You're going to have to understand when to be in the market and when to reduce your equity exposure and, in my opinion, go to cash, okay? And it's because of the new reality. It's, you know, this is just the new normal. And I don't see, it's not going to get any better anytime soon, guys, okay? And it's just the reality of the situation that we have here. So I know I've thrown a lot at you today. Thank you so much for being on this video with me. Again, go out, check out some of my other videos. I got a ton of great stuff out there. If you haven't already done so, please subscribe to my YouTube channel. Give me a thumbs up on this one, and I will see you in the next video.